Welcome back to Strongman Personal Finance. We're going to talk about Teladoc Health Incorporated, ticker symbol TDOC. It also happens to rhyme with AWK. So Teladoc is down 12% in the aftermarket. And the reason is they just posted some not so impressive earnings. If we look at the price performance of the stock over the last year, it's only down 67%. And over the last 5 years, it's down 86%. It dipped. So it's got to be a buy, right? Well, let's go see what happened with the most recent second quarter 2024 results. Purchase NY. Teladoc, the global leader in whole person virtual care, today reported financial results for the 3 months ended June 30th, 2024. Second quarter revenue of $642 million, down 2% year over year. Now, if we go look at the history of the revenue growth of Teladoc, my truckers, you know what? They were having explosive, insane, massive revenue growth in 2020. What happened in 2020? I remember there being a certain lockdown for a certain reason that we probably still can't mention on YouTube. And everything digital just absolutely exploded. I mean, people like Jeremy LaFave and Meet Kevin got popular during this time period. It was the time of free clown money from the sky. And that benefited Teladoc massively because if you were sick and we were on lockdown, how would you talk to a doctor? Oh, Teladoc, okay? But now that the pandemic is over, we can see that revenue growth has massively declined to the point where now they have negative revenue growth year over year. This company has peaked, at least according to the current trends. Second quarter net loss of $837 million. So they lost more money on the accrual basis of accounting versus revenue. Imagine losing more money than you actually generated in revenue, including a goodwill impairment charge of $790 million. Okay, these goodwill impairments have been plaguing this company. A goodwill impairment is resulting from an acquisition of a company that you basically overpaid for. Teladoc acquired a company that they massively overpaid for. The future cash flows that were to be generated by that company were determined to be much less than they initially paid for it, and therefore they write down or reduce the goodwill asset on their balance sheet. When you reduce an asset, you have to debit some kind of expense account because you're reducing an asset, an intangible asset. You're writing it down. That affects earnings. They wrote down goodwill, an intangible asset, on their balance sheet because they suck at acquiring stuff. Second quarter 2024 adjusted EBITDA of $895 million, up 24% year over year. So, of course, the impairment charge, disrupts earnings, right? Because it's a one-time charge. The question is, how much goodwill do they have on their balance sheet? The other question is, what would their profit have been had they not had that goodwill impairment? So if we take 837, let's see, 837.70 minus 790, they still would have lost 47.70. So we take 47.70 and we divide it by the revenue. They still would have had a bottom line loss of 7.4%. Excluding the impairment charge. Now, if we go back to their historical earnings, how are they doing with profit margin? Okay, that's actually, I guess, a little bit of an improvement. There was only one other quarter where it was actually a little bit lower, 4.37% in the fourth quarter of 2023. But they're still losing money on the accrual basis of accounting, even excluding impairment charges. They can't seem to be profitable. Integrated care segment revenue of $377 million, up 5%. Okay, well, one revenue source is up. Betterhelp segment revenue of $265, down 9% year over year. I would imagine, because so many people are depressed, that that revenue would be going up. But I guess during the clowndemic, everybody was depressed and I guess using Betterhelp. So Betterhelp is really what's dragging down the revenue. Okay, and it's a pretty significant chunk of revenue. There wasn't enough from the integrated care segment to make up for the decline in revenue from Betterhelp. I guess those YouTube ads weren't really working that well, okay? So they have some summarized losses here. So we're going to go ahead and look at the financial statements because I don't like what companies do a lot of the time. They try to show you the best data. You want to look at the financials. So we got the 3 months ended June 30th, 2024 versus 2023. It's a comparative analysis. We know that revenue is down 2%. Cost of revenue, exclusive of depreciation and amortization, went down a little bit, but it looks like their margins were probably their gross margin, which is the cost of their directly attributable expenses to their revenue. It's on top of the income statement. It seems to be roughly the same, the margin. Maybe it's a little bit less, but that's not the problem with this company. Advertising and marketing, they cut $8 million of expenses there. Sales expenses, they cut about $3 million there. Tech and development, they cut about $11 million. That's a pretty significant cut. General and admin, they cut that too, roughly, $16 million? So they're cutting all these other expenses. They're cutting ads, they're cutting sales, they're cutting tech expenses, which, is good because this company should eventually, hopefully, return a profit, right? But they had this goodwill impairment of $790 million. This is a massive hit, okay? They are writing down an asset on their balance sheet because their acquisition was god-awful. Okay, acquisition costs are down. Basically, every single expense is down, except this goodwill impairment charge and this increase in the amortization of intangible assets. When you buy an intangible asset like a goodwill, a patent, or a trademark, you don't expense all the cost in that current year. You spread the cost of that purchase over the trademark, patents, etc.'s useful life. That's amortization. Depreciation is tangible products. Amortization is intangible products. We can see depreciation here. So we can see, just by looking at these two numbers, I know their balance sheet is very intangible heavy. The question is, do they have a lot of debt? So we know they have a huge loss from operations. Even if you exclude the goodwill, they still have a 7.4% negative profit margin. So obviously, interest, they have some interest income, okay. Interest expense, immaterial. They have more interest income than interest expense. Amazing. Let's go ahead and look at stock-based compensation. So stock-based compensation is down across the board. Stock-based compensation is when a company gives stock to an employee. The cost of that stock option is determined using, I think it's called the Black-Scholes model. It's this model they use to guess the current value of the stock option. And they spread that cost, that notional value, over the vesting period of the stock option. When the stock option reaches full vesting, the employee can choose to exercise the stock option, which means they give the company cash and the company gives them stock. That's a stock option, okay? Employees are basically buying discounted stock from the company. So stock-based compensation is down, okay? Let's see, access fees. So revenue for access fees is down 3%. Revenue from others up 8%. U.S. revenue is down 4%. International revenue is up 12%. That's actually interesting. They're getting into international. Maybe that'll save them in the long run, but I don't know. Who freaking knows about that, okay? So overall visits are down 11%. They had 4.7 million visits in the second quarter of 2023. 4.2 in the quarter of 2024. So there's less demand for Teladoc. I don't know if it's competition or if it's just because there's not the lockdowns. I mean, a lot of things were very weird during the lockdowns. We also see, integrated care. Okay, we see some growth there. Let's see, average monthly revenue per U.S. integrated care member. It's actually down 4%. Betterhelp paying users down 14%. It's so bad. Imagine buying this instead of VT. So now we have the statement of cash flow. So thankfully, this company is still a cash positive business. And the reason is because a lot of their expenses are non-cash expenses. The big ones are the goodwill impairment, the write-down of the asset on the balance sheet, and the amortization of intangible assets, trademarks, patents, etc., etc. Depreciation, amortization, they don't really seem to have a lot of property, plant, and equipment, or that would be a bigger number. And, of course, stock-based compensation. So these are the three big ones: goodwill, amortization, and stock-based compensation. Okay? So let's see. Overall, cash flows from operations are down. A big one is the difference in accrued compensation. It seems like that's just a timing difference there. That's probably paid to the employees. Let's see here. Okay, capital expenditures. So they're not really spending that much on, acquiring, I guess, more buildings or computers or whatever. They only spent $3 million in the last 6 months, excuse me. And they spent about $60 million on software development. What are they developing? It's still down from the 6 months of the prior year, but they're still spending a good $60 million. This gets put on the balance sheet as an asset, and then it gets expensed over time on the income statement as amortization. Okay, we see proceeds from stock options. This is what I'm talking about. The company got $2.6 million of cash from employees exercising the stock options. And or more actually, proceeds from employee stock purchase plan and exercise of stock options. So about, over roughly 6 million or more of proceeds from stock options, or 5-6 million. A pretty significant amount of cash coming in. So overall, they had a positive cash inflow, but on the accrual basis of accounting, they're still massively unprofitable. Let's look at their balance sheet. They got $1.16 billion of cash, $218 million of accounts receivable. This is money they're due. And those are basically the liquid assets. Cash, accounts receivable, marketable securities if they had them. That's liquid capital. So they have, roughly $1.4 billion of liquid capital. Their current debts are $390 million. So overall, they have enough cash on hand to pay off all of their current debts. And they could almost squeak by and pay off all of their long-term debts, but they don't have enough for that. Let's look at their long-term assets. Goodwill, they basically wiped out almost all of the goodwill. This is the goodwill. You see how the goodwill dropped here? Everybody see that? That's from the impairment. This asset is an intangible asset. It's just from an acquisition. They paid more for a company they acquired than the fair value of the company's net assets. If it turns out the acquisition was bad and they overpaid and the company they bought sucks and it's not going to generate a lot of cash flow, they write it down and that hits the profit and loss. That's why you see that massive drop in assets. You can see intangible assets. So the tangible book value of this company is, the current assets plus the property, plant, and equipment. I don't even know if you count operating lease right of use assets and other assets. But basically, it's half of this. Okay, it's probably like $2 million is the tangible assets or less versus debts of liabilities. So they still have a positive tangible book value, it looks like stuff you can actually touch, like my dong. But their balance sheet isn't as powerful as you might think because a lot of the assets are just deferred costs for patents, trademarks, software research, et cetera, et cetera, et cetera. That's where most of their intangible assets come from, it looks like, is capitalized software development costs. And they have this big fat debt right here, convertible senior notes. I don't know if they paid it all down. Let's go look from financing activities. No, did they have a bunch of stock get converted? Look at this. So convertible senior notes. Oh, no. Okay, here's what happened. So last year, as of December 31st, 2023, they had $1.5 billion of debt. Now they have $989 million of long-term debt, but they also they moved $550 million to short-term debt because that debt's due within a year. So they have a pretty big debt payment due within a year. Luckily, they have enough cash, it looks like, to pay that, and they're a cash flow positive. They're a cash flow positive business. So I don't see imminent bankruptcy unless things rapidly deteriorate with their cash flow. They have enough liquid cash to pay this and all their other short-term expenses. But that's why you see that massive drop in long-term debt, because once a portion of that debt is due within a year, it gets reclassified as current debt. And they have $550 million of debt. I mean, eventually when they pay this debt off, and all the goodwill's amortized, the company's balance sheet won't be nearly as, clownish as it is. So we see some stock issuance, additional paid-in capital's up a little bit, so they're issuing stock. Accumulated deficits. So far, this company has lost $16 billion in losses over its lifetime. And accumulated other comprehensive loss. This is like a very specific category. that skips the income statement. So like derivative cash flow hedges and pensions and available for sale securities and currency translation adjustments. That's what goes here. It affects the balance sheet, but it skips the income statement. So overall, they made a horrible acquisition. They're getting punished for it, and Betterment is just absolutely clapping this company. Okay, I don't like it. I mean, this is just a pandemic stock, honestly. I think a virtual doctor thing shouldn't be that hard to replicate. I'm sure there's plenty of competition out there. This company terrifies me, and I don't know. I'd rather buy VT personally. So let me know your thoughts in the comments below. Cheers.